This is the section, our training section of the call. This is what we get recorded every single week. We get this posted out to our YouTube channel. I'm going to email it out to everybody that's not only on the call, but everyone who is registered to be on the call. And Jimmy and I were talking the other day about, hey, what's a good topic that we can come up with, and we wanted to get get into some strategy, some more advanced sales strategies. Everybody knows is what we specialize in is final expense. I mean, at the end of the day, that's our bread and butter. We are a final expense agency, but at the same time, we're a full service brokerage. I mean, we've got virtually every product that you would need out there, whether it be final expense, mortgage protection, just straight, good, basic, cheap term insurance, index universal life, for putting together, different types of strategies, annuities, that sort of thing. But if you're working on the final expense lead platform, I would say, probably 95%, maybe even higher, of the clients that you're going to go to, it's just going to be straight final expense, which is pretty straightforward. But what we want to do is we want to talk about maybe some of the cases and some of the areas when you walk into, and it's not as straightforward as your regular final expense client. Maybe it's a little bit more complex. Maybe they're not your traditional 65-year-old client who, had a heart attack 5 years ago and is diabetic and not really in good health. We do come across clients that are in spectacular health, and quite frankly, maybe, they deserve or they need a product that's a little bit better than a final expense product. No disrespect to the final expense, but let's face it, it's a table 6 product. It's written at a table 6 for a reason. That's because the majority of the clients that we're dealing with have some, usually, either multiple minor or some significant health impairments. They're not the healthiest in the world. So in that case, when you're writing these smaller face amounts, 5, 10, 15,000, final expense is typically going to be the best answer 95% of the time. But we don't want you to lose sales. We want you to be able to have the ability and have the ammunition, if you will, to be able to handle some of these other cases. And if you are, I'm going to ask everyone, if you're viewing this video on YouTube, this is a replay, and you're catching us. If you hit the subscribe button, get subscribed to our channel so you can get all the latest updates that we're doing. So Jimmy, one of the products that you wanted to talk about was the Mutual of Omaha is the GULE, correct?
Correct.
Okay, all right. Let me see. I think I put a slide together for that. This is just kind of a scenario here, guys, of a kind of a GULE, and maybe, Jimmy, you can talk to us a little bit about, when would you personally make the switch? You're going in to see a client who it's off of a lead, and you're assuming that you're going in to write a final expense client, but then maybe if there's something that triggered that say, hey, maybe this is a good GULE client instead.
Okay, great. Well, when you have a client that I'm going to say is looking for a face amount of, let's say, starting with 20,000 and up. So in this particular case, Joe went with 40,000, but it could be as little as 20,000. Okay, and the reason why I say 20 and not 25 is GULE, the minimum face amount is 25,000. But if you're quoting somebody at 20, because that's what they want, you could probably get them 25 on a GULE for about the same price, right? So starting with the mindset of a minimum 20, you can go this route. Now the other thing, you can read the numbers for yourself, so you can see the savings there. But the other thing you want to look at is the health. These people have to be healthy, and Joe and I talked about this, and so we agreed that we need to define what is healthy. What does that mean, right? Because the living promise underwriting guidelines are different than the GULE guidelines, right? So GULE, by the way, stands for Guaranteed Universal Life Express, okay? And the guarantee is you're going to guarantee this product to last to a specific age. So in this case here, we're guaranteeing that face amount to last to age 120. When you do it to age 120, it essentially becomes a whole life, okay? But this product has flexibility. You can guarantee it to age 100. You can guarantee it to age 80 and anywhere in between. And it doesn't have to be 5-year increments. It could be to age 103, right? So on your phone app, it's only going to give you a few preset dates, but you can guarantee it to any age from 80 to 120, but you're going to have to do the illustration on the software on your computer. Okay, so just thought I'd throw that out there. But let's go with this example. Mr. Roger here is age 65. He wants $40,000. That's the maximum coverage allowed by Living Promise. And his premium payment with Living Promise is going to be $216, right? And change. And maybe that's out of Roger's budget, or maybe it's not competitive with something else that he's looking at, right? So when you go with Guaranteed Universal Life Express, you can see the savings. You can take that down to $164, much more competitive and much easier to make the sell. Would you guys agree?
I
Right.
would agree. I
So,
mean,
so,
yeah, definitely.
so I'm not going to get into all the big details about medical underwriting. Here's what you need to do. You need to do your own due diligence. You can download the underwriting guidelines from Mutual of Omaha's website and read it, right? The other thing you can do is you can take the GULE application and read the medical questions. The knockout questions are different than Living Promise, right? So don't think, oh, just because they qualify for Living Promise that they're going to qualify for this. I'm going to give you probably the number one example, and that's what stumped one of our agents this week, was that even though they were approved for 40,000 with Mutual of Omaha and the policy was issued, and even though they really didn't have any like red flags anywhere on the app, the one question on there that did raise a problem was on the GOLE is, are they currently receiving disability benefits, right? And that's not a question we're not used to asking on final expense. So with a GOLE, if they are on disability, that's an automatic decline. There's two exceptions. If they're on disability for spinal or knee, and those are the only two exceptions. Any other disability, it's a turn down, right? So make sure that you do your due diligence. Make sure you familiarize yourself with the health questions and read the underlying guidelines. It's very, very important, right? Because you don't want to shoot yourself in the foot, quote a 164, and then they get turned down, because it's going to be really, really difficult to switch that person to 216. I think everybody would agree with that, right?
Yeah, just to add on to that a little bit, guys, is that this is it's a great product. Jimmy and I both have written a lot of GULE before, but you just keep in mind this is not a final expense product. It is different. I know agents have called me and it's like, yeah, I got this guy, and he wants a higher face amount. We're talking about like GULE. Yeah, he's really healthy. Hardly, just like, high blood pressure meds and cholesterol and he had a heart attack, but it was like 10 years ago. Okay, guys, that doesn't qualify him for GULE. Those major events like heart attack, stroke, if they've ever in their lifetime have had one of those episodes, they're not going to qualify for this product. So we got to keep in mind, man, this is for the client that you're meeting with. They're in really good health. They go to the doctor on a regular basis. They can be on the regular medications, uh, high blood pressure, cholesterol, that sort of thing. They can even be diabetic, as long as their diabetes was diagnosed after the age of 50 and there's no complications. Okay. But they can't have the coronary artery disease, heart arrhythmia, those types of things. It's a it's a great product, but just keep in mind it's for a client that it like a slightly higher caliber health wise than your typical final expense. And if you just a little tip here, and I've had situations where I've had clients that are in their 60s and maybe even 70s that they did want a bigger face amount. They wanted $50,000 worth of coverage, and they had the financial well-being to afford it, but they weren't GUL clients. They weren't going to get approved because they did have a heart issue or had bypass surgery 5 years ago or something like that. What do you do in a case like that? You sell them two policies, not with the same company, but I've done many instances where I've placed $40,000 with Mutual Omaha, and then did like an additional 10,000 with another carrier. So that's another option if you do have that client that is looking for a bigger face amount. They've got the money to be able to afford the premiums, but they're not going to fit into this product. And the other product we're going to get into in a minute, which has very similar underwriting, is the Foresters Advantage Plus whole life product. Jimmy, I'll throw it back over to you, unless I can go to the next slide, see what I have here.
Okay. Well, here's what I wanted to say. You can see that the price is very competitive. I've, I do the medical underwriting, the field underwriting up front before I ever quote anybody, right? So let's just assume that I did a good job and I've already determined they're a good candidate, right? So, this is what you guys need to learn to do. And let's also take a case scenario where maybe I'm going up against a competitor that's already in force. So I see this a lot of times. Maybe they're with American National or Reliable, or those are debit companies, or maybe one of our other competitors like Lincoln Heritage or something like that, right? And they have, a lot of times they have a $15,000 policy in force, okay? And they're looking to double it. They're looking for another 15, right? So I'll do both. I'll quote them 15. Like in this case, let's say I quote them a 15 MU living promise, right? And I add that to what they're already paying. And then I also quote them the GULE for the 30, right? And you're going to be shocked at how many policies you can replace, right? I mean, it just makes sense. There's been cases where people have had policies for 3, 4, 5 years even, and the rate is substantially less doing it this way, right? So just kind of keep that in mind, and then we'll show you another strategy in a second. But go ahead and go on to the next slide.
Okay. This one just talks about the Advantage Plus whole life, which is this is a true whole life product versus the Mutual. The GULE is a guaranteed universal life policy that is designed to have a level death benefit the entire time. The one of the unique thing about the Advantage Plus is that it's a participating whole life where the dividends can be reinvested into paid up insurance. And I think I put a chart together here for you, but you can kind of see the difference in the. Let me go back. Like, let's see, am I going the right way? Yeah, okay. So here where we had Roger, age 65, we're doing a $40,000 face amount, GULE, guaranteed to age 20. Premiums are 164. If you compare that to the Advantage Plus, it's the same client, 40K. Now this one is you only pay to age 100. It's paid up at that point. There's no premiums due after age 100. It is a few dollars more. It's about $4 or $5, $6 more than the other. Okay. There's also on the Advantage. There's also a 20 pay. I don't sell a lot of that for the older clients because it is really expensive. That 20 pay is a great idea if you have a younger client, like in their 20s or 30s, that wants to have the insurance paid up so they don't have to make payments on it until the rest of their life. But when you're dealing with clients, I'm just telling you, when they're already in their 60s and 70s, sometimes those 20 pays mathematically doesn't really kind of make sense to do it. Because you can see here for the same client, Roger, age 65, a $40,000 face amount to have it paid up in 20 years, which means at age 85, he'd have to pay $247 per month. But let me just show you this other scenario here real quick, and then let me click on a pen here real quick, or actually a highlighter. Okay, so if we look over here at, I'm just showing from age 80. So this is, if you look over here to the far left, this is 15 years into the policy. So this is, remember, this is Roger, age 65 when he took it out. So at age 80, in 15 years, these are the premiums. He's going to build some cash value, the premium outlay, accumulated paid up additions. So his policy is actually going to be worth, have a death benefit of $42,640. If he makes it to age 80, he basically is getting like $14,000 of free insurance because that's when it's paid up. So if you look down here at the bottom, and if he pays on it for 35 years, gets to age 100, let's see, the face amount or the death benefit would actually be $54,737, which is approximately $14,000 more than when he started with the same premium. So even though the premiums on the Advantage Plus Whole Life are a little bit more than the GULE, you might be able to justify it because of those paid up additions. Let's see what the next one here is. And let's see, here's something else. Let me talk about the Advantage Plus Whole Life here. Just another kind of a cool thing about this product. It also has a term rider that's available, which the GULE does not have. So here's a scenario. This is the Advantage Plus Whole Life with the term ride scenario. So we got the same client here. We've got Roger, who's age 65. In this case, let's say Roger is looking for a higher face amount. Like he wants more than just final expense coverage. He wants, 50 or 60 or maybe even $70,000 worth of coverage. But he also wants to make sure is that if he lives to, 100 or 110 or however, into his 90s, is that the policy doesn't expire and he at least have something there to cover his final expenses. So in this scenario, here's what I did for Roger. I lowered my face amount. I did an Advantage Plus Whole Life. I put it in for a $25,000 face amount that's paid up at age 100. I also added a $50,000 term rider, which means is that Roger has $75,000 of coverage for the next 20 years. He's covered until age 85. for $75,000. Okay, his premiums are going to be $234 a month for 20 years. If he makes it to age 85, that term rider is going to fall off, and then his premiums are going to go back down. Now he only has to pay for the whole life insurance. So now for the next 15 years, from age 86 to age 100, his premiums would actually only be $109 um, until age 100. So this is a pretty cool. I really like this product. I've sold quite a bit of it. I think it's a unique product. Just remember that this is, again, it's not Advantage Plus Whole Life is not a final expense client or product for that true final expense client. You got to make sure that these people are a little bit a higher echelon health wise than your 65-year-old client who you know has artery disease and had bypass surgery 7 years ago. Not going to be the right client for this product.
And
Jimmy,
Joe, I
let me
wanted
throw it back over to you.
I wanted to say something. Both this product and the GULE that we mentioned previously are express issue, meaning that there's non-med. Like actually, they both have the option to go express issue. So meaning you don't have to wait for blood in urine, you don't have to schedule a paramed exam, and both have the option of going fully medically underwritten, right? But so
Oh, true, true.
we're giving you the express issue quotes and the express issue option. So we are telling you that they have to be healthier, but these products that we're showing you right now don't require any kind of medical exam, blood or urine sample. These are still express issue. They're still going to, be processed within a few business days, and you're still going to get paid rather quickly on it. So just thought I'd throw that in there.
Right. If you do have, that's a good point. If you do have a client that is looking for, a larger face amount, 100,000, whatever, it would, and they're healthy, they go to the doctor on a regular basis, it would probably be a good idea to go ahead and get it fully underwritten, just because of the difference in the pricing. So when you're doing the calculation, like with Foresters, and you select this product, it's going to ask you, are you doing non-med or medical? For our clients that are typically, you know, 60, in their 50s and 60s, we're typically doing face amounts of, 25 to maybe 50,000. So in those cases, we're going to go non-med. I don't know about with the Mutual of Omaha product, but I know with Foresters, Jimmy, if you want to do fully underwritten, the the minimum face amount is 100,000.
Mhm.
Is that the same with Mutual?
I'm pretty sure that you can do fully underwritten at a lower face with Moo.
Okay. I
I
don't,
can double check for you.
yeah, I don't know about with Foresters. I can check real quick. Let me just do that. Let's see,
But
Advantage
sake of
Plus.
time, let's move on to another strategy.
Okay, go ahead.
So I don't know what slide you have prepared next.
This one just talks about the GULE as like the term alternative.
Okay.
So this would be a situation, and I'll look to see about the Foresters, but again, this is Roger, age 65. I put in a $40,000 face amount, and let's say he's looking to cover something for 20 years. You could do it to age, like you said, pretty much any term you want, 85, 90 to 100. Um, it just so happens at age 65, if you were comparing that to the Term Life Express, it's actually a 20-year term on a 65-year-old isn't even available. You would have to take it down to 15 years in order to do that. So let's talk about when you would use GULE as a term product instead of a permanent product?
Well, so, let's say the 65-year-old, he wants to have coverage to age 85, just like this slide says, 20-year term. Maybe it's not the 40,000. Maybe, they want a higher face. Maybe they still have a mortgage. Maybe they have 100,000. Maybe they have $150,000 mortgage. But whatever the scenario is, as far as face amount goes, it's going to be a lot less expensive to guarantee this to a certain age. So you can pick the age. In this case here, we're going with 40,000, guarantee it to age 85. That drops the payment to 118.86, right? As to compare to, what was it previously, Joe, for the age 120? 160 something. I think it was 164.
Yeah, 164.30 to guarantee it to age 120.
Okay, so all right, so now let's go back to this slide, guaranteeing it to age 85. It's the same face amount, same, carrier, same product, but now they're basically saving, 50 bucks, 48 bucks a month. And that's one way that you can play with it. And you can make that age 83, 84, whatever age you want. The lowest age you can guarantee is to age 80, right? So that's just another way of quoting somebody that's in their 60s, kind of like using it as a term alternative, right? Sometimes, sitting down with clients, I'll ask them, how's the longevity of life in your family? Like if it's a male, right? Like Roger's male, how long did your dad live? How about your grandpa? How about your uncles? And if he says, you know what, most of my family, they're passing away in the 80s, and he's looking for a whole life solution, but the age 120 was not competitive. Well, maybe I take that down just a tad, and maybe I take that down to age 100, which I'm still giving him plenty of room in case he outlives his family's history. You can do the same thing for females, but don't try to bring it down to, if they said mid 80s, don't bring it down to 85. He's looking for a permanent solution, and be conservative, but just know that you have that flexibility, and explain to the client what you're doing. I can guarantee it to this age, and it'll drop your payment to this. Will this work for you? Right? So I only do this as if, I quote them to age 120 and it's still out of their budget, and they don't want to move on face amount. They don't want to lower the face amount. Well, then you can explain to them how that works and see if that's a viable solution for them.
Yeah,
So
just one note on this product, it's not renewable. So like if you like so if you guarantee the premiums until age 85 at the 118 as an example, um, if Roger asks you the question, well, what if I live to 87? Roger's not going to have coverage at 87. This is what we have to kind of think about the GULE is just in your mind, think of this as like a permanent term insurance. Like, so when you're guaranteeing it to age 85, that's when the policy ends. There's no option at the end to like pay higher premiums to have it continue on. So just as like Jimmy was talking about, if your clients are really seeking to have permanent life insurance, um, you know, only covering them to age 85 is not a good idea. It needs to be longer than that. The kind of the unique thing about the GOLE and the reason why we like the product so much is that you can offer face amounts all the way down to 25,000, which is which is great. There aren't a lot of products this competitive that you can go down as low as 25,000. And I just verified with Forster's. I tried running a quote. If you want to go fully underwritten with a medical exam, 100,000 is the minimum face amount for that. And the for the Mutual of Omaha product, I'm not. You're saying, Jimmy, you think you can do fully underwritten for a lower face amount?
Let me check. You know, to be honest with you, Joe, I stay clear from fully underwritten, so I don't know the answer off
Yeah.
the top.
All right. Guys, it may or may not be available. I mean, but at the end of the day, we're mainly, trying to do as much simplified issue as possible. I mean, uh, if they're healthy and they're looking for, you know, a higher face amount, another company you could look at is National Life Group. Um, they're non-med. They have face amounts. You can go down as low as 50,000 on that. So that's typically where I go with my clients. Maybe in their 40s or 50s, even in their 60s. They've got National Life Group has a really good. Actually, have a index universal life, but also their whole life is an outstanding product. And you can get it done. It's fully underwritten, but with no medical. Okay. So again, not a final expense product, but for those healthier clients, like I said, that they go to the gym, they work out, they go to the doctor on a regular basis, they get an annual physical. Those are the clients that would be candidates for like a National Life Group type product. So the other thing, Jimmy, before we move on, any other little tips or strategies that we want to give as far as utilizing either the GULE or the Advantage Plus whole life?
No, I think we're good to go on that, Joe.
Yeah, I think we're good to go, guys. Just get yourself educated on these products, man. I really like Foresters, really like Mutual of Omaha. These are two really great products that you should brush up on and definitely have them in your arsenal for when you come across these some of these clients that we're talking about with the higher face amounts and replacing. The other thing, just one real quick thing, Jimmy, before we move on. Um, we're talking about running across competitors' products, and sometimes we do have that situation where we go in, we meet with a client, and they already have 10 or 15,000, and they're looking for another 10 or 15,000. They're looking for 20 to $30,000 worth of coverage. Um, did you mention before, especially if they've been in the policy, let's say they've been into their existing whole life policy for 5 or 6 years, and maybe they have some cash value. What about calling into their current carrier and getting a quote for a reduced paid up?
Yeah, I haven't talked about that yet, but let's go ahead and cover it.
You're kind of the master at that, man. I mean, I know you've done that. I mean, there's been many cases I know where you've done that. Kind of like walk me through that scenario, like when maybe a client would be a good candidate to just take the policy that they currently have and doing a reduced paid up on it.
So normally a scenario works where they've had it for a while, right? They've had it, let's say for example, a 7-year period, right? They've had it long enough that the rate that you're going to quote them today, in most cases, is not going to be competitive with what they're paying now, right? So that's the first obstacle in selling a new policy, because in their head, they're thinking, okay, if I want to double my coverage, I'm just going to double my payment. And many times it's like, considerably higher than double on the payment because they're older. So that's the first obstacle. And some people understand, but they don't understand, if you know what I'm saying there, right? Like they kind of get it, but like they really don't want to accept it, right? So what I do is I review their policy, and in the policy it'll always show the paid up, the what they call the reduced paid up life insurance. So when you're looking in a policy, it'll show by year the cash value that's accumulated, and usually on the same page in a different column, it'll show like what their surrender value is if they take a paid up insurance. So like as an example, let's say you had somebody that had a $10,000 policy and they're looking to increase it and go to 20,000, right? So I might be sitting with a client and maybe their paid up policy is about 3,500. Okay, that's a really like good example. So I can quote them a GULE and try to get that premium down if they qualify medically, right? And then take their paid up edition and add it towards it. So maybe 10,000 is not a good example. Maybe let's go with 15,000. So maybe they have a 15,000 face, and then they want another 15. They want a total of 30, right? So I can quote them 26,500 because they're going to get the other 3,500 from their paid up, right? So they've already been paying into this other policy. So now we're only having to look at the cost of that premium. And I don't have an example to show you, but in many cases, it's a little bit more. I can tell you by memory, I wrote a case where the gentleman was paying $96 a month for his policy. He had it for 7 years. We took the paid up edition and quoted him the difference, and he was only going to have to pay, I think it was like 112. All right, so essentially he's going to go from a $96 payment to paying 112, but he doubles his coverage. Does that make sense? Right? So I'm trying to make it clear for you, right? So that totally makes sense. That's less than double, and they jump on it, right? So then sometimes what they come back and say is, well, what if I just take the cash value? How much would my payment be? So then I quote them that payment. And sometimes, be honest with you, most of the time they want the cash value, and they're fine to go with the higher premium. But I don't ever push that or quote that to them. I let them ask me that question. Sometimes that question never comes up, but they see the value in, keeping the paid up policy that they already have and then just going with the policy for the difference. And this really overcomes another obstacle that people have, is having had that policy for a long time. They're attached to it. They've paid into it for all these years. They don't want to just give it up. Oh no, I'm not going to just replace that policy. Well, you know what? We're not. You're right. You put money into this. We're not going to replace it. We're going to take the paid up portion of it and then just get you a quote for the difference on what you're looking for. So that's a good strategy, and it really works. So
It does. I'm with you though, man. The majority of the clients, when I've used that strategy and I say, like, here, Mr. Smith, you've got $1,800 in cash surrender. If you were to surrender, this is and let's say, and usually it's about 2 to 3 times that amount for the paid up. So, 1,800 could be like somewhere between $4,000 to $6,000 of paid up insurance. I'd say the majority of my clients said, I just take the money. I'll take my check for $1,800. So, but guys, the thing about it is, if you're not aware of the technique, then you may miss an opportunity. And this is the whole, the reason why we do these calls every week is to give you those, these little tips that Jimmy and I have learned throughout the years to be able to overcome some of these objections. So, yes.
Before we move forward, I'll just tell you like just a quick story, quick example. I had a lady, same exact scenario, and she says, well, and the company, I don't know if I should say it. Is it okay if I say who the company was or no?
I don't care.
Okay. So the company that she had the existing policy was Nationwide, which Nationwide is a what do you call it, P&C company, right? They do auto insurance and home insurance, but they also sell life insurance. So first off, the rate wasn't all that competitive, right? So that we had that working for us. And she had owned this policy for quite some time. I think it was about a 10-year period, okay? And she goes, well, you know what, Jimmy, I want to talk to my daughter because my daughter's the one who sold it to me. She's still with Nationwide, right? But now she's like in a district manager position or something like that, right? So her daughter's not really a producer no more. And I said, oh, okay. So I laid it all out. She reviewed it with her daughter. Surprisingly, the daughter wanted to meet me, right? So we had to set up a second appointment, and she was blown away with the strategy. She told her mom, this is the best thing for you. You need to do this, right? Because she knew that her mom, wasn't going to qualify for a better coverage with them. Their underwriting guidelines is way stricter than like the GOLE. You following me?
Mm-hmm.
So we did it. We moved forward. She took the paid up edition. I only, covered her for the difference of what her mom was looking for. And the premium, I'm going to say, was like maybe another $25 a month than what she was already paying. It just totally made sense. So, I mean, guys, we're doing the people right if it makes sense. If they have enough cash accumulated, it makes sense. I'm not one to go out there just to replace policies to make commissions, but I am going out there to make sure that whatever solution I provide really benefits my client. I want it to make sense for them financially, and it needs to make sense. And if it does, well, then if it means replacing a policy or surrendering the policy to take up, a paid up death benefit, then that's what we're going to do. But I always keep my client's best interest at heart. So, but let's go on to the last one we have for him, Joe.
Sure. And the last one, Jimmy, is going to be just a little bit of a tip on when we're doing a 3-option worksheet, the technique that both you and myself use, which is the combo quoting for couples. Okay. So that's going to be our last little topic. This will be nice and short. What I've kind of done here is I just drew it out before the webinar started, and kind of did it maybe kind of the traditional way that you may think, like when you have a couple. So Jimmy, what I had here is let me get a different color highlighter here real quick. Change this to red. So guys, like on option 1, we have 40,000 for natural passing, 80,000 for accidental, and I have a husband and wife. So I'm showing the husband's premium here of 230, and I'm showing the wife of 168. And I kind of go all the way down the row. One thing that you'll find, and especially if one of the couples has a health impairment, where their rate is going to be a lot higher. Now, these I did as just traditional, non-smoker, both level benefit.
Hey,
Typically,
Joe,
sometime.
I don't see the slide you're talking about.
Oh, you know what? I paused it there for a minute because I think I was making some modifications on it. You see it now, right? Okay. All right. Perfect. All right. So, guys, this is kind of like, if you didn't know about this technique that Jimmy and I are going to be talking about, this is kind of how maybe you would normally do it. Is you would show, do your face amounts, then you would go down and you would maybe write in the premiums, something like this. The point I was saying, in this scenario, they're not, I mean, there's a difference, but they're not drastically different. Sometimes if like the husband is, let's say, has COPD and they're a smoker, the rate's like twice the much is what the wife's policy is. In this case, you can see it's roughly about $62 difference. And as we go down, what Jimmy and I like to do is, when you have husband and wife, is you just add them up together. So it's one figure. So when you're looking at 40,000, it's it's instead of having those higher dollar amounts here as a combo, they would need to set aside 398 for option 2 for the 25,000. It would only be 251, and for the 15,000 for both of them, it would be 153. And I think psychologically, Jimmy, when they look at this, they're just in their mind, they're just kind of splitting it in half. Like, oh, it's a little bit under 200 a month. For the 250, it's a roughly 125 bucks a piece, and for the 150, it's roughly $75 a piece, roughly. And this especially helps when you have, wouldn't you say, Jimmy, it's especially beneficial when one of them has like, let's say, like a health impairment, or one of them has to go guaranteed issue where the premiums are a lot higher.
Yeah, so sometimes you have one spouse is either a lot older, or they're older and they're a smoker, or they're older and they're going to be standard, or maybe they're just standard, or maybe a standard smoker, but like they got one or two things that's really going to kick the cost higher than their other spouse, right? And again, recently I had a client, I think it was for 20,000 what I was quoting, or maybe it was 15, but for him, it was going to be $105 a month, right? And actually, it was for 10,000. Now that I remember right, for him, it was going to be $105 a month for 10,000, and I knew he wasn't going to be happy with that. But for his wife, it was only going to be like $39 a month, right? So when I quoted 10,000 for 144 a month, and this covered both of them, like Joe said, they kind of average it out. And so in his head, he's thinking, oh, that's only like 70 bucks a piece, $72 each. Yeah, that's a good deal. And they bought it. And you know what? He told me after, I was done writing them up, how great the pricing was. He said, I've had all these people come out and they were just like, really, quote me really high rates. And I think what it was is they were probably just starting with him,
Yeah.
and he was shutting them down. And then what's cool is that, a year later, he called me to come back out and write some more, right?
Sweet.
So that's why I say it's recent, because I recently had to go out there and rewrite them, and I just did the same thing, just did a combo deal. So make sure that you don't write the numbers down separately where they can see them. Make your notes, but you're only going to show them, as you see here, the one cost that's going to cover both of them. Make sure they understand that this is giving each of them coverage, right? And that after the first one passes, the other one still has their coverage, right? Just let them know. A lot of times they will clarify that with you too. Is that each, or is that for both of us? No, that's for both of you, I tell them. And they usually they always really like it. So I'm just telling you, you'll get some sales that way.
Yeah, do the combos. All right, guys, we've man, an hour goes by fast when you're having fun. So that's it, Jimmy. Let's end off on this. Is a great way to end it off, man. We've covered a lot of great sales strategies and some advanced techniques for our agents. So I appreciate you getting on and helping me with the call here. Always greatly appreciative of all your input. So with that, man, everybody, Jimmy, have a great weekend.
Are you going to Detroit?
What's that?
Are you going to Detroit?
Oh no, dude, I might. No, my daughter's got a dance competition this weekend.
Oh, okay.
Yeah, sorry I didn't get back to you. Sorry, I'm gonna miss you in Detroit. But all right, everybody. Well, have a great weekend. God bless, and we will talk to you soon. Take care.
Okay. Bye-bye.
All right, man. Take care.